we have the Magnificent 7, and then we have the mediocre 493. Okay, so the Med 493, not the Mag 7, but the Med 493, that multiple is 17 times.
Okay.
So you take the Mag 7 in and of itself, which represent 32% of the S&P 500 market cap, is huge. Their multiple is about 31, 32 times those 7 stocks. The outlier there is Tesla. You remove Tesla from that equation, the magnificent remaining 6 is like 25 times.
Welcome back to the Intelligent Investment Show, presented by ARPG and Matt Dahl. As you can see, his nice, pretty, shiny ARPG sign in the background, and I guess a joint venture we could call this with myself and my YouTube channel, Wealth Partners. I'm Garrett Lale. Matt, always look forward to chatting with you. Had a nice call yesterday, and
we probably got to record our pre-production meeting. They're kind of fun too.
We really should. I mean, I don't know. There's not much of a difference between our pre-production meeting and this. I mean, we kind of prepare, but then we're still shooting from the hip at the end of the day. So anyway, Thanks for coming back on here again. So I kind of brought up to you interest rates and how we're flirting in this what appears to me to be like a technical support resistance level in that 420 range, 420-ish. But then you kind of redirected me on that, and you said it really has more to do with the technicals kind of responding to the fundamentals and fundamental shifts in the data. So let's start off there. You mentioned some CPI numbers, ISM numbers. So what's going on in the economic data side that's kind of led to the interest rates trying to flirt with this low level?
I think a great way to sort of start off would be we had a technically driven yield market. It showed us exactly that after the debate, right? We were still living in that sort of that 4.25 up to, 450 kind of range, right? And inside of that, there are 2 different levels of support and resistance, 425 and 435. But there's that range that it kind of lived in, 425 to call it 455, somewhere in there. And it would bounce back and forth there depending on what specific news came out, small exogenous events, treasury auctions took place, but there wasn't really much to move it one way or the other. Okay? The debate took place, and I remember that night, the futures, the 10-year on futures, it was at about 426. I think that day it closed at 423, 424, so it didn't really move. I looked at the futures before I left the office. Before I left home to come to the office, and it was 427, 428. By the time I got to work, it was at 444. Okay, because we went from futures to the bond market opening. The bond market actually opened, volume spiked, and it sold off. Okay, now that's perfectly fine. No economic data nothing happened that moved it as far as fundamentals concerned, right? Nothing. No CPI came out, PC didn't come out. There wasn't anything that really took place that would have moved the bond market other than the debate based on the bond market's belief that having Trump in will have generally higher yields because we might have more GDP growth. There'll be more deficit spending because we'll have lower receipts to the Treasury because of corporate tax cuts and general tax cuts that Trump would do versus a Biden presidency. Thus, higher deficits, higher interest rates. Okay, so it was the bond market kind of moving within its technical pattern based off of sort of a minor exogenous event. Okay, but it really never went through. I mean, I think we went to 423, 424, but it never really violated that. And then we had CPI come out on Wednesday morning, right? And specific inside of the CPI basket, we had shelter. Okay, it's every month's been 0.4, 0.4, 0.6, 0.5, 0.5, 0.6, 0.4. The last several months in a row, it's all been 0.4. And it's like waiting for a Godot. CPI is not going to really contract and really start to really, really cool until owner equivalent rent shelter, because that is, I think, 44% or 42% of the CPI component all by itself. Okay.
What was that number you said? Owner's equivalent rent?
Shelter, owner equivalent rent.
Okay. What is that? What does that mean? Give us
apartments.
Okay.
Apartments. So your home prices, they go up. Okay.
Mm-hmm.
Well, rent goes up. Owner equivalent rent. So if you were to rent your house out, that's the price move.
Okay.
And that's been very, very, very sticky. 0.5, 0.6, month over month, it went to 0.2. And that was the fundamental thing that took place that moved us into a different range. So the technical patterns give you sort of the guardrails. And you move around within supports and resistance depending on the current data set that we have. So fundamentals to me are always the boss. Something fundamentally has to change, the fundamental, right? To move those guardrails one way or the other. And for that technical pattern now, which I think is valid, okay, for technical patterns to then resume in a different range, whether now my guess is we'll probably live in sort of the 385 to 415 range on the yield. And if we continue to get cooling in CPI, okay, if we continue to see the labor market cool off, right? If we see jolts come in lower than consensus, if we see continuing jobless claims go over 2 million, if we see initial claims start to get near 300,000 a week, then you're going to see yields start to really, really cool off. You're going to see a lot of people start to run to the treasury market to buy safe.
To you, it always goes back to the fundamentals. There are other people out there that are totally opposite of you and think that technicals are really the only thing that matters and fundamentals they could care less about. Not necessarily a right or wrong, I don't suppose. Kind of like, do you want your steak cooked rare or well done? I mean, it's personal preference, I suppose. But do technicals matter more in some markets versus another, right? Like, are technical levels paid attention to more in equity markets versus fixed income markets? And you could expand that even more to say, what about real estate or cryptocurrency or whatever market that you wanted to, you could pigback futures for all I care. But that conversation kind of led to this analogy where you explained kind of what you said about the guardrails and that they kind of define the rules of the game. And you were talking about baseball and using the fundamentals kind of give you the rules. The rules change. Well, then, we're going to see patterns change.
Fundamentals create the baseball field, and you play on the baseball field, and the technicals move between the bases depending on how the fundamentals allow them. So a pitch gets thrown, the batter hits it. That's a fundamental operation of a baseball game. He gets to first base. Let's just say for purposes of this argument, you're not really allowed to steal. So he will stand there between first and second base, or she will stand there between a softball game, I guess. They'll kind of live in that first and second base area until something fundamentally changes.
Yeah.
Another batter gets up, smashes the ball, and gets him to second base.
Yep.
So back to technicals versus fundamentals. So let's look at the end of this year. So end of this year, earnings should be 245, 247. Okay. So we're looking at 247 on a trailing multiple of 22 and a half, to call it 22 times, or a $275 multiple for 2025 on a forward multiple of 20.15, which is a good forward multiple, about 20 times on forward, 22 times on a trailing, right? You're at about 5,600 on the S&P end of year. Now we're over that right now, so shows you what I know, right? So let's just say, okay, well, the technicals are in control. Okay, well, so does that mean the market is just going to continue to go up and up and up without any sort of fundamental interaction or engagement? Of course, that's where it always has to come back on the fundamentals, because under that rationale, the market can just effectively continue to go up and up and up with no earnings growth. Okay. Well, the math matters. The fundamentals matter. The earnings matter. Here's a good example. Let's say something takes place that causes there to be a massive change in earnings expectations for the end of this year and into 2025. Let's say Biden wins the election and he announces a massive tax increase beginning January 1st of 2025, where he takes corporate taxes from 21% to 45%, effectively doubling. Okay. That's going to represent $50-$60 a share on the S&P. Now, all of a sudden, we're going from not making $275 a share on the S&P 2025 to making $220 a share. Okay. Now, that's a fundamental change that would take place. right? So obviously you then have to change the math tremendously. We couldn't be sitting at 5,600 at the end of this year with a forward multiple of 20, which is a good multiple, if we now think we're going to have $215 a share on the S&P 500 into 2020, which of course we will not have. That has not been proposed. And Biden, of course, even if he did win, certainly would not raise, can't imagine he would raise taxes from 21 to 45. He's probably just going to raise the taxes as he said he would from 21 to 28.
To be totally fair, I'm not sure that Biden can imagine what he's going to do, though. So I don't know that you could really necessarily say that with a whole lot of confidence. I mean, I'm not even sure that he's 100% sure what he just did, much less what he's going to do.
No, I'm pretty sure he's not sure what he's doing right now. He's probably talking to himself in the mirror, having an argument. You know,
calling it a liar.
Tell that guy who's pointing at him to get out of his face.
I got to say, again, I really thought this might be the first show in a little bit that we got back to our we're not going to go political thing. Because we always say we don't want to go political, and then we end up talking politics. But it's not to be political. I just find it humorous, right? Like, it's just really entertaining.
This is interesting. This is historic what's taking place. People say what they want. They can agree. They can not agree.
You can love it or hate it. Right. Yeah.
You can say, hey, you can believe that Biden should stay in the race. You can believe that Biden should step down. You can believe it shouldn't matter because you're a Trump person. You can be like me and be an independent. And frankly, I'm gonna vote for a bowl of ice cream for president. I can care about it. For me, as long as the market goes up,
I mean, are we allowed to sit out? I mean, like everybody says it's like your civic duty and you have to do it. And if I don't vote, I will go ahead and tell you I'm not going to admit that I didn't vote. I'll like find me a sticker. So I'm sure you can buy a sticker online that says I voted or whatever, but I'm not 100% sure that I want to vote because I don't really want to vote for either of them. So like, are you a horrible person, horrible American if you don't vote because you don't like either of them?
Well, I would like to believe in a vacuum that we're casting our vote for the person that we believe is going to A, do the best job, B, reflects our values, my values, for economics, foreign policy, as a person, as a father, as a husband, a member of my community, whatever it is. If people that don't vote, I think they're making that choice because they can't make that connection with either one of the candidates. As free citizens of a free country, we get to make that call. We get to say, you know what? It's not that I don't want to participate. I just don't think there's anyone there that shares my values that for me is worth getting off the couch, standing in line, and voting for somebody. Now, then there's the other side, and it's a perfectly valid argument. Well, you got to vote for one. You have to vote for the lesser of the two evils, right?
Yeah.
Who's the lesser of the two evils? And that's what people are voting for. But the problem is, if you keep going down that road, you end up with the lesser of two evils every time.
Yeah.
Which is frankly where we've gotten to. Now we have two choices that I don't know that many people are all that thrilled about. I think it's one of those scenarios where there's no real right or wrong to it. And you have to be respectful of folks that actively sit out, stab me in the eye or shoot me in the ear. I don't know. I just pick either. You
pick. I don't care. Either way.
So,
just pick one already and quit bothering me about it. I don't want to have to think about it anymore.
Right.
Well, that little ADD derail moment brought to you by Adderall because apparently mine's not working today. I didn't mean to get us off on politics, but the fundamental thing that can shift can kind of come from two different ways. I want to get your thoughts on this, and this was not in the pre-show notes, but one leads to the other, right? You've talked about it before. The economic data, specific, your earnings. Let's really start there. Just the simple ones: the earnings, the net income, net profit of corporations. That's one piece of the formula. But then the other formula is what's the multiple that investors are willing to pay for that dollar of earnings. And there are times that investors are only willing to pay 10 times earnings. And there are other times that they've been willing to pay, on individual stocks, 50, 100 times earnings. And, but even on the market, you can get to, in the tech bubble, did we get 30 or did we get to 50 during the tech bubble time? What was the PE multiple during tech? Do you remember that?
The S&P 500 got near 30 The NASDAQ
It was the NASDAQ that got
got
crazy.
65 or something.
Yeah.
It was really, really high. It was really,
So,
high.
So that's where you get these like cascading markets that just fall off a cliff, or when you have that sudden economic shock, you have earnings go down, and then you have scared investors not willing to pay as much of a multiple for those earnings. And then, the flip side of that is, on the, like take COVID, you kind of have both of these happen during COVID or during 2020, right? In the first half of the year, it fell off a cliff in the first 3 months because we thought we're going back to the Great Depression.
Yeah, like we're not going to have earnings at all.
Right. And then you had the total opposite effect of that by the end of the year, where people realized, no, wait, we do still have an economy because we've had a lot of money put into it and earnings weren't hit as much as we thought. And now we've got a whole bunch of money sitting around that we didn't expect to have because of stimulus. So in that year, I mean, it wasn't a major paradigm shift, but you did see multiples themselves changing as well as earnings themselves. So, I mean, my gut instinct is that the fundamentals are primarily, 70-30, 80-20. It's the data itself changing. But then there's also the factors that affect how much we're willing to pay for that. Interest rates play a big part on how much we're willing to pay for a dollar of earnings, right? Because if we can get 10% in the bank, we're not willing to pay as much for a dollar of earnings because that's equities, which is a little bit more, it's a different flavor of risk than fixed income. But when we were only getting 0.5% in the bank, we might have been willing to pay a higher multiple for any earnings because we couldn't get anything in the bank. We might as well put it in the stock market. When you're looking at data and building your market outlook and setting your year-end targets and things like that, how much of that is you looking at the data to see what the multiplier or multiple is going to be, or is the multiple itself going to expand from 22, 23, and then you're just looking at the numbers to see what to multiply it by? Or are you looking at, this is something that could fundamentally make us go from a 20 to a 25 multiple or a 20 down to a 15 multiple?
Well, a lot of it is that, again, back to fundamentals, right? It's what is the growth on those earnings? If we're sitting at 20 times, right? We're sitting at 20 times forward. Actually, we're at 20. Right now, we're 21.2 times. It's about the same as we were 2 weeks ago. We're 21.2 times earnings. Is that a fair multiple? Is that a good multiple? Is it a high multiple? Well, it's a historically high multiple. Okay. But we also have a pretty strong economy, and a lot of the companies inside of the S&P 500 are growing at a tremendous rate. So if you take that 21.2 multiple and you remove the Mag 7, the Magnificent 7 from that equation, the rest of the market, we have the Magnificent 7, and then we have the mediocre 493. Okay, so the Med 493, not the Mag 7, but the Med 493, that multiple is 17 times.
Okay.
So you take the Mag 7 in and of itself, which represent 32% of the S&P 500 market cap, so huge. Their multiple is about 31, 32 times those 7 stocks. The outlier there is Tesla. You remove Tesla from that equation, the magnificent remaining 6 is like 25 times. Okay, so if you are able to compartmentalize those two, okay, 17 times isn't really that high, isn't all that bad. Okay.
Yeah.
With earnings growth, with decent earnings growth in the 8-9% range for that group, well, now you have 8-9% earnings on a 17 multiple. Okay, we're looking at close to a 2-to-1 ratio there. That's on the upper end of it, but it's not outsized. But then you look at the Magnificent 7 or the remaining Magnificent 6 and call that a 25-26 multiple. That average growth rate is closer to 30%. Okay. So we actually have a 0.8, 0.9, 1 point, and a 0.9. I haven't done the calculation in a few days, but it's closer to a 1 times growth to multiple ratio. Okay? Mm-hmm. So the multiple, if you look at it as its own little bubble, and people get on the media and talk about this all the time. They go, well, because I'm not willing to pay 21 times on a S&P market because every time it gets here, it craters. Well, they're not looking at why it's there and what will justify that 21. Because if it's growing, if you take those 7 stock or the 6 remain, because I don't take a position of Tesla, but if you take the 6 stocks and say, okay, they're 26 times earnings, right? And then we're looking at their growth rate of 26.5% or 30%. I know that in 2 years, I'm buying those companies for closer to 14 times earnings, to 15 times earnings. That's a deal. That's a good deal. So as long as we can this is back to the confidence in our data, right? As long as I can be confident in the data set that I'm getting, and confident in those growth rates. The multiple in and of itself, just looking at that, I think is an absolute, is a mistake. And that's technical, back to the technical side of it. Technicians tend to just kind of say, well, the multiple's here, so the market will probably just move from this level of support to that level of resistance, and that's what will happen, and da 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 da. But as earnings start to grow and they start to move that multiple down and it continues to move the market up, then they start to resume those different patterns that they use. Don't get me wrong, and there is some validity to those technical patterns because it is the decision making of the market that's taking place on an aggregate basis, as you can see in real time. Okay. And because they're so widely utilized now, and frankly, it's a lot easier to be a technician than it is to be a fundamentalist. Being a fundamentalist takes a lot of work. Okay. You have to do earnings, do the math. Whereas technicals, you can kind of look at a chart and go, yeah, it's going up, or yeah, it's going down, or yeah, it's kind of sitting flat. And yeah, I can see it's here. It's been here before. It's there again. And if it blows out, it's probably going to take off. And then you go into the fundamental side. It's like, oh, and then we go into earnings and, oh, I see why it's starting to break out. Okay. That's why. Okay. Perfect example. The debate moved the yield up almost 20 basis points the next day, right? Because of the deficit spending that the bond market believes Trump's going to do, which was frankly the bond market saying Trump's going to win the election. But okay. And then CPI came out Wednesday. We're at 419 now. Okay. It immediately cratered. But that was a fundamental move. CPI was fundamental. The debate was not. If something else would have happened that's not a fundamental, we would probably see the 10-year sitting at 428, 427. It's still kind of sit in that range that it's been in for a long time. But now we fundamentally moved. So here's a good example. Where's the market going to go? Where's the market going to be? Are you going to look at technical patterns? Okay. You can look at a technical pattern and say, well, the market's at 56.30 now, and it looks like it can go up, you can use Fibonacci retracement numbers and general. Well, if it moved this far over this period of time, it will move half that amount over this next period of time. I get all of that. But here's one thing we can't forget. Okay. S&P earnings for Q2 are expected to be $58.80 a share. So $58.80 Q2. Next quarter, Q3 earnings are 7% higher than this quarter. Not year over year, quarter over quarter.
Wow.
Quarterly earnings are expected to be 62.68 for Q3. Now, let's fast forward to Q2 of next year. 67.44 earnings a share for Q2 of 2025. That's a 14.7% increase in earnings. Okay. So at 21.2 times earnings right now, with a 14.7% earnings growth rate, we're sitting at 1.5 times, a 1.5 ratio of growth of multiple to growth. That's fine. That's perfectly healthy. So the multiple doesn't bother me at all. Now, so you can see the technical patterns will adjust as earnings come in and market continues to go up. If that number were to collapse, that number, which is clearly a fundamental component, right? If that number collapses, technical patterns are done. It violated this and it violated that. It broke down. Well, that's because the fundamentals allowed it. Back to the baseball field. Until that batter, the next batter, hits that ball and is able to put himself or herself on base and get that next runner to second base, and then those two runners start running between first and second and third, nothing's really going to change. Okay? There has to be an underlying fundamental catalyst, whether it be on the bond side, the earnings side, the dollar index, which is breaking down right now too, which would be really good for I think S&P earnings specific to technology. Okay, so one of those things have to take place in order for the technicals to then work within a range, because the technicals will work within a range, right? The fundamentals will put the yields or the prices in that range.
The fundamentals kind of determine what the range is going to be, and technicals live within the range that fundamentals give them to work in.
Right, and that's always been the tricky part is, well, what range will it be in? Where are we going into, right? What are the earnings going to be? If you're going into a 14.7% earnings growth with interest rates that are going down, which they are, that's a great place to be. This is Goldilocks risk. This is Goldilocks for the equity markets. It's when earnings are like in 2022, going into 2023, earnings were flat. They were zero. There was no growth. There was zero growth from 2022 to 2023. Okay. So the market started pricing in that zero growth and higher interest rates. We had rising interest rates in 2022. So that was the opposite. Now we have the other side. So, but we do, I absolutely believe interest rates are going down. Back to CPI, right? So core CPI is exactly 3.27% core right now. It came in at 3.3, but they round it. It's 3.27. That's the core, and that's based on all of the components and their weightings and everything. But I actually think it's pretty helpful to look at the median CPI number, which is different. Okay, median is basically it's the midpoint. So you take all of the values and you range it from smallest to largest, and you take the middle number. Or if it's an even number, you take the two middle numbers, you average those two out, and that's your number. That number is 1.5.
Where's the list coming from that we're getting the median from? All the different components?
All the different components of CPI. So
okay.
If you arrange them if you arrange all the individual components from basically, not disinflation, but, deflation numbers, all the way through to the highest components that are inflating, like auto insurance. Okay?
Mm-hmm.
And then you find the mid number, that's actually 1.4, 1.5. And another thing I saw is if you take the pre-pandemic average inflation number year over year, right? The whole thing, the whole enchilada, 2%. Yeah. That was the number, 2%. It's been talked about forever, 2%.
Yeah.
We're currently at 3.27, 3.3. Okay. Now, that exact same number, that exact same equation, if you just remove auto insurance and shelter, housing from that calculation from the year 2000 through 2019, that pre-pandemic era, that 20-year period where it sat at 2%. By removing shelter and auto insurance from that calculation, you're at 1.4. We're currently 3.6 against a 2% pre-pandemic level. Okay. Now, that number is 1.4x shelter and auto insurance, right? Today, year over year, although we're sitting at 3.3, 3.27 exactly, if you subtract shelter and auto insurance from that number, we're at 0.9. So we're actually below the pre-pandemic average. And so it's those two components that are just the outsized excess inflation numbers that are really causing the problem. So that's why if you look at the median CPI number, it's pretty low. And that's why we know inflation, and right now housing and auto insurance are absolutely crashing and rolling over. So we think there's going to be a lot of disinflation coming our way, okay, which is good, which will absolutely prime the Fed to start cutting rates. And they should. If they wait too long, it's going to be a problem. In fact, Dow Jones issued an article today. It's time for the Fed to end the waiting game. And you and I talked about this 5 months ago.
Yeah.
4 months ago. Why do we have to wait till we're walking up to a burning building before we turn the gas line off? I'm not talking about throwing water on it, but why do we have to have an inferno before we shut the gas off? We're starting to smell the gas.
Yeah.
You know it's coming. Let's shut the gas off. Okay. Yeah. And so there's cases being made now for a July cut. I think that's highly improbable. I think they should. Whether they do it or not is different. I think they should do it. Okay. I don't think they will. We're giving it about a 10% chance. I think the market's sitting right now at a 9% chance that they're going to cut in July. But I think what you're probably going to get, in fact, one of my advisors today came up with an interesting scenario, and I think it's equally likely as anything out there, based on the current data set that we have, based on the direction of the data set. Right? I think we're absolutely going to get a cut in September. It'll be a 25 basis point cut. But then let's revert back to when they increased interest rates. How did they do it? They didn't just go in 75. They went 25, and then 50, and then 75. They ramped it up, right? And it will depend on what happens with the data specific to the labor market that would cause them to adjust this, right? But we'll get that 25 basis point cut in September. We might skip November and then get another one in December. So that's where we're at, kind of like 2 or 3. Okay. However, I think November is slightly more likely than not having November. Okay. But I also want to preface that by saying we might get Novembers in December. So we actually might get a skip in November and then a 50 basis point cut in December.
Yeah.
You know what I'm saying?
At the end of the day, that's what the market cares about, right? Like, the number of rate cuts is most significant because we assume it's going to be 25 basis points each time. But at the end of the day, what the market really cares about is what that level is going to be at a certain point in time. So the market doesn't care that much. I mean, I'm not going to say it doesn't at all, but it doesn't care that much whether we get 3 25 basis point moves or one 75 basis point move in 6 months, because other than just the discounted future value of cash flows aspect of that, for the most part, all the economy really cares about is where it's going to be. Am I right?
Yeah, because I mean, basically, policy rate is going to set it's the SOFR. It's the secured overnight financing rate between banks, which is what sets their base cost on money, and then they loan out from there, right?
Right.
So as that cost of capital comes down at a most fundamental level, right, then of course the risk premium increases.
Yeah.
Right. We don't think they're going to cut in July. What we do think we're going to get is an interesting equity market between now and the election. And it's going to be based on communication from the Fed and several other factors. Our base case is the FOMC meeting on July 31st, very last day of this month, right? That press conference is going to be a preparatory conference where Jay Powell prepares everyone for a rate cut that's coming, that's going to be imminent. And they're going to start a reduction of policy rate cycle. That's what July's meeting is going to be. That's what July's press conference is going to be. It's going to be communicating what's coming, which is going to be a rate reduction cycle. Okay. But they're not actually going to cut. What's going to happen is, I think from the end of July, beginning of August, the market should do pretty well up into September, into the next meeting, when they actually do the cutting. And from there, I think with the actual cutting, the market will sell off at the cut into the election. And it's going to be sort of a buy the rumors, sell the news. It's going to be the Fed saying, okay, we're having to reduce interest rates. There might be some economic data that supports that, which is a slowing of the economy a little bit. Not a bad economy, a normalization of the economy, going from ultra hot to cooling off, right? And of course, going into an election year, a pretty volatile election year, actually. And we'll probably see that sell-off happen right at the rate cut into the election to about 5 to 7%. Pretty normal, maybe a little bit more. But that's what we're going to see. But I don't think you're going to see equity markets really have the opportunity to sell off with any material magnitude while rates are going down, while the dollar index is going. Earnings appear to be strong and growing. Interest rates appear to be going down, but we're going into an election. So we're in an election. There's a lot going on. The other thing I found pretty interesting is how off base the general population is certain things, right? So the 1 year break even rate on inflation right now, which is it's called the 1-1, 1 year from now, where will inflation be? Now we know we're sitting at 3.27 right? Investors believe it's going to be 3.9. Okay. We believe it's going to be 2.4. ARPG's 2.4, 2.5 1 year from now. Okay. Investors believe it's going to be 3.9. Where is that coming from? Right? Are they looking at the individual components of CPI and seeing it roll over? Or are they just feeling generally dour about prices? I think that's what it is. They're just feeling generally dour. You're seeing a lot of negative confidence in the economy from the consumer. In fact, UMich came out today at 66. The consumer confidence, the University of Michigan Consumer Confidence Index came in at 66, down from 68.2 last month. Its lowest reading in 8 months. February of 2020 was 101. That's how bad people are feeling about the economy. And the economy's doing pretty good. Earnings are doing pretty good.
Yeah. I think it's hilarious. I mean, that's all you hear about in the political campaigns and commercials and stuff is how bad the economy is. And it's like, it depends on who you ask, I suppose. For investors, they love the economy. I mean, the stock market's been terrific. Equity, home prices going up is good for homeowners and for landlords. And there's certain segments of the economy who have benefited from those price increases, right? McDonald's isn't thrilled about selling the $5 cheeseburger meal, right? They liked being able to sell them for $9 or whatever it was. So some people have liked this economy.
Right. And Target just announced a bunch of price cuts, and now we have the $5 value meals coming back and all those other things. Yeah. So, there's just this again, not to overuse the word, but this dourness about what's happening in the economy. The economy is doing actually okay. And you just, not to be anecdotal about everything, but you can go to a restaurant and they're busy. I mean, the pizza place that we all go to here, Dom DeMarco's, it's the best pizza place. Portnoy gave it a 7.9. I think it deserved an 8.4, but gave it a 7.9. Phenomenal pizza. Great guy. Al there. He makes the best pizza in Vegas. We love him. You go there.
Shout out. Sponsorship plug.
It's slammed. You can't walk in. You're going to wait 45 minutes before you can get sat down. You go to any decent restaurant in Vegas, any decent restaurant in North Carolina where you're at, anywhere, and they're busy. They're very, very busy. You walk through a nice grocery store. they're slammed. There's a Trader Joe's right up here. It's a kind of a hippie dippy type little grocery store where you buy $75 avocados and everyone's walking around in straw hats. It's one of those places, and you can't get in there on a Sunday. There's so many people. There are flowers everywhere. It's like you're gonna get stung by a bee, and it's still full. People want to spend their money.
Earnings season's getting ready to kick off. Give me 3 stocks you're looking at in the next couple of weeks earnings, and what do they mean? Or 5? I don't care the number.
Well, we had JP Morgan come out yesterday, and they actually beat earnings, which was good. Wells Fargo did not beat earnings. Their NIM or their NII, their net interest income, they gave guidance. In fact, Wells Fargo's down today 9%. Okay, because they gave terrible guidance on net interest income for the next 12 months. Right.
Is this I don't know if this is a question that is always the same or if it varies quarter to quarter, but what's more important right now, what the earnings are or what the guidance is?
Oh, I think it's absolutely the guidance. I think it's absolutely the guidance because I think earnings, the market they've already priced in what's already happened. So unless there's some outsized event that moves those earnings down, I mean, I can't imagine that. Well, let's pick on NVIDIA. We love picking on NVIDIA. Let's say NVIDIA, it misses earnings but gives strong guidance. What would anyone do, right? It would be one of those situations where do they sell off because they missed earnings, or do you buy it because they gave strong guidance? I'm a believer in guidance, but I'm also a believer in the confidence of the data sets, right? You buy the companies or you buy the indices that you can believe that the guidance that they provided 3 months ago, you're going to be in that ball field. If you're buying an over-the-counter penny pink sheet stock, and it misses earnings by 50%. Well, you kind of had that one coming to you. What we're looking for is I'm interested in see what happens with bank earnings, right? Specific to the net interest income story, because I think that's specific to yields going forward. I guess it'll be in mid of August, when NVIDIA's earnings come out. That's the number everyone's going to be looking at.
Yeah.
Okay? And they're going to blow earnings out, and they're going to increase guidance. And it's going to move that multiple down from, the 42 it is now, and it'll move it right back down to 28. And it'll just keep on chugging on. There's no stopping it.
I think we're out of time. As always, the Intelligent Investment Show is for really everything on the Wealth Partners YouTube channel is for informational and educational use only. Nothing that we say is intended to be investment or financial advice. But I do know a guy, and he's on the call, so you can give him a call if you do need to seek a professional. You can reach Matt at, I actually have the number, but I think it's almost tradition to let you say it. So what they can reach you at?
702-655-8300. Any one of our advisors would love to help.